Hi, my name is Bill Burke. I'm the Managing Director for Ground Rush Financial. And the purpose of these videos is to help you introduce yourself to clients, how to be interesting, how to educate clients, how to educate yourself. There are tools for you to listen to rehearse, to practice, to get better at this. Along the way, you should be aware that I can help you. I can go on cases with you. I can do Zoom calls with you to make this all happen. But this is stuff that will help you understand and how to talk to people that you haven't talked to before, or at least have conversations with friends or family that you've avoided because you weren't sure what to say. So this is going to be a presentation that I do for a client. So let's take an example, and this happens all the time. You get a client and you think they're an annuity prospect. So you do your call, and what you're going to say to them is, and the client either asks or you bring it up and say, well, how are you feeling about your investments and how are you feeling about losing money and yada yada, and they say, I hate it. Say, well, I want to ask you something. There are strategies out there that can really help you avoid losing money. They're popular, but they need to be understood, and I'd like to have my business partner, Bill Burke, meet with us for him to explain how this works for you and why it might help you. And at the end of the day, if it works, great. If it doesn't work, that's fine, but there's no harm, no foul in this. With that, would you be okay with that? So now you've got the person interested, and we're now going to have a conversation, assuming that we have gotten some data, we know what they have, we know they're worried about it, so now we're going to present the concept and the product to them. Now, this is going to be the way I do the presentation. It's on a Zoom. These are prepared, and we're not going to give these to the client because these are illustrations that are part of a bigger illustration. So we're not giving this client this. We're using these to explain the product so they get comfortable to make a decision. So recognize that. So let's go how we start off. So someone's brought me in. We're going to see the client. I've already gone through, by the way, establishing the fact that I'm a guide. We're getting on the same page. There's safe money. There's money at risk. Now we're going to talk about something that will help you secure your future and get you returns with no risk. All right, so that's the conversation. So John, nice meeting you today. As Jim suggested, I'm going to walk through something that might or might not appeal to you as I go through this. I'm probably going to get into some more detail that frankly is going to bore you because it's stuff that you need to know, but the stuff I'm going to tell you is important so you feel good about any decision you made. And anytime you have questions, ask me. I'm going to go through this on a fairly broad-based high level, but we'll come back to issues that are on your mind. Does that sound reasonable so far? All right. So here's what we figured out so far. We know that people like making money. People don't like losing money. And it's okay to stay the same, but people really seem to need to increase their revenue. They need to increase their assets, either for themselves or their family. Is that a good place for us to start? Would you agree with that or not? All right, so we got agreement. So what I'm going to do now is I'm going to go through an example of how this type of product works. Now, this is going to be called an indexed annuity. So before I start, what do you know about indexed annuities? What do you feel about them? Do you have any? Tell me what you know. And they're going to tell me, well, I hate them, or I don't know. I listened to Dave Ramsey. They all seem to be bad. I expect them to not have great feelings about indexed annuities. But they also don't know why they don't like indexed annuities, so they don't have the facts. What I cannot do is I'm not going to be good if somebody's had a relative or family member had a terrible experience where they lost money or some major crisis happened. So let's assume we're dealing with someone that is really okay, open to listening to this idea. So let me explain how this works. You're going to notice that we have several items here, and we're going to deal with a $100,000 deposit. And you're going to notice I labeled these columns A, B, C, and D. And you're going to notice the first thing is this, on the left-hand side, there's all these different investment accounts. Now let's make a statement, first of all, that the annuity companies are now doing deals with major investment managers of different industries. So what happened 10 years ago is that the annuity companies knew they had to provide better returns, so they partnered with other investment companies like PIMCO or outside investors. The difference between Morgan Stanley and an annuity company is Morgan Stanley does not guarantee safety. You're in there for the rewards. The annuity investment company, their primary concern is safety. You cannot lose money. But they had to do something else. They had to offer you a better return, the ability to participate in the market without the risk of losing. That's a very unique concept, and it's something that most people are sort of unaware of. So think of an annuity company as a big investment company with safety as their primary motivation. Does that make sense where I've gone so far? All right, now, let's talk about what these choices are. You're going to notice we have Standard & Poor's. That's the S&P index. Are you familiar with that? How familiar are you with the markets and stock market? Because they should be. And then this company called Global Balanced Index. That's a third-party investment manager that deals with global commodities, different country stocks. It has international flavor. And then you have U.S. Fundamental, which is all about U.S. stocks. So we can blend and mix and match, but I'm going to choose U.S. Fundamental today because I want to give you an example of some things that are very important to know. So you're going to notice the column C shows you the current returns. Now, 4%, for example, if you look at that, that is basically almost like a CD, but it's in this annuity. So that'll be there for a year. As interest rates go up, this will go up. As interest rates decrease, it will decrease, but you're locked in for a year. But you're also tax deferred. So if you earn 4%, you're not going to pay tax on it. It's going to be accrued inside the annuity. That's a good thing. With me so far? All right. Now you're going to notice these other returns, 10.5, 13, 205 participation rates. These are all going to be important to understand later on, but that's what we're dealing with, and I'll come back to that. So this will be sort of interesting for you today because this is not something people are used to when they see this type of strategy. So let's now move on to the next page and talk about one of the big issues that comes up with annuities, and that are called withdrawal charges. Have you had any experience with people talking about surrender charges or withdrawal charges? And they're going to say, well, yes or no, or whatever. Well, the reason, and I'm going to say something very controversial right now, the reason you should have an annuity is because these charges exist, because these charges mean that safety is primary. So if someone leaves early, the people that stay should not lose any money. So that's where these withdrawals comes into play. And you're not forced to take a withdrawal, but even if you are, there's something called a 10% free withdrawal. So if you needed money, and I'll show you in a little bit how that works, you can take out 10% of the value of the annuity without any surrender charges. That's because life happens and emergencies happen, and the companies recognize that. So that's something you need to be aware of. So far, does that make sense so far what I'm talking about? You notice what I'm doing? I'm stopping. I want them to know, are they listening? Do they get it? What questions do they have? All right, now let's talk about the actual math behind this. Now I'm going to show you some numbers, and these numbers are going to look really incredulous to you, but they're real numbers. So we put $100,000 in, and column A is your $100,000. Now column B is the actual return. Now think about this, 13.47%. That's a big return. So here's someone put the $100,000 in, they earned $13,470. So their account value is $113,000. They would say that's pretty good. Well, let me say column B, these are the actual returns the last 10 years. I don't think they'll be this high in the future, but they'll be good returns, but nowhere near 3 or 4%, albeit you'll see some low returns here. You'll see 0.27, you'll see 3.34, but overall those returns are impressive. Well, that's what these annuity companies are doing, is letting you participate without any risk of loss. Now you're going to notice, and let's go down to column B where I do this reset. Now here's what's critical, and this is what's so unique and what is so important that you need to understand and appreciate. There's a 22% return, so this person had, at the end of that first year, he has $210,000. The market dropped 20%, but the floor is 0. So that 210,000 stayed at 210. Does that make sense what I just said? Can't lose any money. 210 stays there. Market went up an unbelievable 23%, which is probably, I'm not sure that's ever going to happen again. But let's say it goes up and you got 49,000. That gets added to the 210, so now you have $260,000. And it's locked in. You can't lose that. So with me so far, does that make, because that's the huge issue. You cannot lose money. You can only keep what you've gained. So far, are you okay with this? I want you to look at between C and D, there's a free withdrawal. That means that in year 4, if you want to pull out $15,900 without any penalties, no withdrawal charges, that's available to you. So that's every year. That gives you a little escape hatch. Now, if you said you needed $400,000 or something right away, you wouldn't be doing this annuity. We're saying this is done because you have this money. We don't need it immediately, but it'd be nice to have it grow. Between D and E is the surrender charge, is the withdrawal charge. Now, the reason this exists is we have D and E, and now we're going to have, if you left in year 2, you would have left $9,783 on the table. Now, why would that be important to me? Because I'm going to stay in the annuity. Because all these contracts with these outside investment companies are based upon long-term decisions and contracts. So if you leave early, I shouldn't be penalized because you decided to get out. So that, again, the point of the withdrawal charges is safety. It's to keep you safe. It allows me to continue to grow my money. So if you planned on getting out in the next 10 years, do not do this annuity. Does that make sense? Because that's really one of the big criticisms of annuities. So far, we go okay? Column right of F is really important because notice that's the death benefit, and it stays exactly what the accumulation value is. So I know this is going to sound silly, but there are no penalties for dying. You die, your heirs get everything. All right? That's really important. And notice this all ends in 10 years. There's no more surrender charges. So from that point onward, the accumulation value, cash value, and death benefit are all the same. With me so far? Now, I want to explain this reset provision, and we're going to talk now about this power of guarantee minimums. And so if you look at this, what this happened on this annuity is when you were losing, when the market dropped 20%, your $210,000 stayed at $210 because you can't lose. The people outside that lost 20%, you'll notice there's a loss here. Does that make sense? You're going to see that you stay at a level 106 in this example. The market dropped 20% down to 92,000. And then when the market rebounds, you got 6%, so you're up to 112, and the 92,000 grew back to 101. But the key is, in this annuity, you only are going to deal with the zero floor and whatever rate of return we get, whether it's 10%, 15, whatever the chart said. This is the critical issue to be aware of and why this is so unique. Does that make sense? All right, now, let's move on to the next page. We simply go into the rest of the annuity, but now we're going to talk about what happens and where is this return. So here we now have the column A says U.S. Fundamental Balance Index did 6.57%, but they got a 205% participation rate. So next page, I just am reminding you that the participation rate is 205%. So multiply any of those numbers by 205 and you get, for example, 13, 17, 18%. Just remember, this participation rate goes up as interest rates go up. So when in a market where interest rates are rising, the annuities do better and better because they have more money to buy more participation rates. When the market drops and interest rates drop, these rates will drop. So the interesting thing about annuities, you cannot ever lose any money, but as interest rates go up, it actually helps your return. So that's a discussion point we can talk about later, but it's really important because bonds, annuities, are a substitute for bonds. So that's where this 205% comes from. Now, what I want to also wrap up now is telling you what's the good news and bad news. Well, so here is when we look at this annuity, we're going to now show you the worst 10 years out of the last 20. So that meant that those rates of return was 11.03%, so your money grew to $284,000, and that's the worst, and that was between 2012 and 2021. But during those years, I want you to look what happened. We had a negative year, meant negative 0.83, 0, 0, and there's the reset, 210,000. So again, they see that reset protected me in the bad years. In the top years, best years, it was a 13% return. It grew to $351,000, so $67,000 more than the worst return. But again, there is a reset that whenever there's a zero market, you are locked in where you have, and you only get to move up with the gain. You cannot lose money. Does this all make sense to you as we go through this? So what questions do you have, and is this something that we should be able to explore and do the next step? Let's talk about what you'd like to invest, what questions still come to mind. Now, what we've done on this is how I explain it to clients. We need to have dialogue back and forth. This is I've found it's a lot of fun to do this because clients really don't understand any of this. They need to be explained it. It's got to be patient, but it works out really well. So hopefully this helps you, and we can again help you explain this to clients. That's what I do with you. Thank you.